One of the most popular ways to organize a business is through a limited liability company, or LLC. In a past video, I touched on the basics of how LLCs work and how they can be treated for tax purposes. But there is still quite a bit of confusion regarding this form of entity organization, which I'm going to try to clarify in this video. I'm the Tax Geek, back with more of your taxes, oversimplified. Not too long ago, if you wanted to shield your personal assets from your business liabilities, you had no choice but to form a corporation, which is a complex and expensive process requiring, in many states, detailed and elaborate reporting procedures. Towards the end of the 20th century, business owners who wanted to shield their personal assets from their business's liabilities had a new option, the Limited Liability Company, usually called an LLC. Under an LLC, states grant individuals or groups protection from business liability without subjecting them to the organizational and reporting requirements of a traditional corporation. By 1997, every state in the Union had enacted some sort of limited liability company statute, and they have become increasingly popular since then. Unlike traditional corporations, which have stockholders who own fixed shares in the corporation, an LLC has one or more members who usually decide among themselves each member's ownership stake. And unlike traditional corporations, which must be treated for tax purposes as either an S or a C corporation, LLCs can continue to be treated for tax purposes as sole proprietorships if they have just one member, or as partnerships if they have more than one member. LLCs can choose to be taxed as corporations for tax purposes if they elect to be. Sole proprietors or partners can form an LLC simply to take advantage of the limited liability it affords and continue to file their taxes in the same way they always have. At some point in the future, when it would benefit them to file taxes as some sort of corporation, they can make that election when they're ready to. Every state has different requirements and procedures for forming an LLC. A good place to find out these requirements is the website for your state's Secretary of State. Once an LLC is formed, most states require some sort of annual re-registration. One slight disadvantage to the LLC is that LLCs are usually only recognized in the states where they're formed. If you do business in other states, you usually have to register that LLC with those states, otherwise you do not receive shielding from business liabilities in those other states. Here's an example. Dan and Donna formed Dan-Don LLC in Massachusetts to sell high-end women's shoes. Their business was so successful, they opened a second store in Connecticut. However, they neglected to register their LLC with the state of Connecticut. One day in the Connecticut store, a customer fell off some high heels she was trying out and sustained a serious injury. In this case, Dan and Donna can be held personally liable for any monetary damages. Had this accident happened in the Massachusetts store, only the assets of the business could be used to satisfy the judgment. Now that we've reviewed what an LLC is, let's see how forming an LLC affects your taxes. First and foremost, an LLC is a form of business organization and not a classification for tax purposes. This is unlike forming a traditional corporation, which, in addition to being a form of business organization, has an immediate effect on what tax returns the business must file. For tax purposes, the IRS considers an LLC to be what is called a disregarded entity. A single-member LLC continues to file its taxes as a sole proprietorship using a Schedule C, and a multi-member LLC continues to file its taxes as a partnership using Form 1065 and passing any profits or losses through to the partners. But once an LLC is formed, the member or members can elect to be taxed as either a traditional C corporation or as an S corporation. As a C corporation, the LLC files Form 1120 and pays taxes on its profits, and then, if it elects, shares some of those profits with the members as dividends. An LLC electing to file as an S corporation files Form 1120S, reporting its net income. This income is then split among the members, and each member pays tax on their share of the net income, much like a traditional partnership. Both C and S corporations can pay their owners W-2 wages, which potentially saves on self-employment tax. An LLC can elect to be treated as an S corporation by filing Form 2553 or a C corporation by filing Form 8832. These elections can be made anytime during the year before the election is to take effect, but no later than February 15th of the year the election is to become effective. For example, Phil is a landscaper who operates as a sole proprietor. During 2022, he forms Phil's Landscaping Adventures LLC. If he desires to be treated for tax purposes as an S corporation for 2023, he can file Form 2553 anytime during 2022, after his LLC is formed that is, but he must make the election no later than February 15th, 2023 for the election to take effect that year. So to recap, an LLC is a form of business organization that shields its members' personal assets from business liabilities. Unless the LLC elects otherwise, single-member LLCs are taxed as sole proprietorships, and multi-member LLCs are taxed as partnerships. LLCs can also elect to be treated for tax purposes as either a traditional C corporation or as an S corporation. There are other videos on this channel covering the differences between the various types of business organization and how partnerships, S corporations, and C corporations work. You'll find links to these videos in the video description, as well as links to resources and additional information. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. Your questions, comments, or suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.